What's good, everybody? Welcome to a new episode of the time frame alignment model. If you struggle with daily bias, if you struggle with knowing where the daily candle will print, what the order flow is, where the higher time frame will move towards, you want to watch this entire episode. I'm going to teach you exactly what I look for in price action and why my daily bias is always so accurate and almost always know where the daily candle will go. We're going to touch on a couple of topics. We're going to go over the higher time frame. We're going to go over market maker models. We're going to go over candle closures, and all this will blend together into finding an accurate daily bias. So let's go to the syllabus again. We've gone over 4 episodes. Today is the order flow top down, the daily bias, and this is going to be a very important video in determining where you want to trade from. So daily bias. So step-by-step approach, higher time frame perspective, candle closures, market structure on the 4-hour, continuation purges, and at the end of the episode I will have a practice routine for you so you can practice your daily bias every single day. Now let's start off with the higher time frame perspective. We're going to touch on a couple of topics. First of all, we're going to talk about the market profile. We're going to talk about premium and discount and key levels. Now, what is a market profile? A market profile is something you determine before you're going to analyze. So you're going to watch the chart. You're going to look, are we in an actual bullish trend, or are we in a bearish trend, or even are we consolidating? If you can determine you are consolidating, you instantly want to avoid that asset. That makes it really easy to pick out your assets. But we're going to focus on the bullish and bearish market profiles. So over here we got a US dollar, Canadian dollar chart, a daily chart. It's a naked chart. And I want you to watch this chart, see if you can find different types of market profiles. I will indicate what I'm seeing over here. First of all, we've got a consolidation here. Notably, candles close and open in the same area, never leaving the range. So this is a consolidation profile. If we go to the next one, this is an actual bullish market profile. You can see price willingly moves in one direction, and you can clearly say, okay, we're definitely reaching for buy side liquidity over here. It is not going sideways just like over here. And then the other one is the bearish one. We have a clear downtrend over here. You can clearly see, okay, we're displacing down lower. We're leaving fair value gaps behind. Not like here, right? We're not moving with any fair value gaps. There are a couple, but there's not an indication that it will hold. So 2 types of profiles is what we're going to be focusing on. And notice where I put the boxes here, right? The bullish box starts down here and not down here. And I will explain it to you why that is. And same with the bearish one. So first of all, we're going to touch on a bullish market profile. So we're going to be focusing on that piece of price action I showed you earlier, that bullish box I draw out, right? We're going to be focusing on this piece of price action over here, because this has a clear trend to the upside. This market profile is bullish. First of all, think about the previous episodes, right? We're going to implement everything we already learned. So first of all, range high, range low. Order pairing, very important to know where the market will trade towards. We can see clear uptrend over here. Low got swiped, and now we want to order pair the high that is attached to the low. First of all, we talked about market profile, but we also need to know premium and discount on the higher time frame, right? We need to know, are we hitting a key level in discount? Are we actually moving away from discount? And does it make sense that we're trading higher from this area? So we've got a premium and discount range over here. This is the weekly time frame. So previous chart was a daily chart. And we're going to be focusing on this piece of price action over here, because this is where the bullish move happened. What kind of profile actually did we have previously, right? So if you look at this over here, we've got a bullish market profile, and then price goes sideways. And if you paid attention to the previous episode where we talked about market cycles, we know expansion can lead into consolidation, and consolidation can never lead into a reversal, right? So price moving lower is not a reversal. So you can always look for a liquidation of an old low and then expect a continuation up higher, because market cycles, it makes sense. With the PD race over here, bullish order block, continuation purge, and we're going to be talking about continuation purges a little bit more later. And we can clearly see, does it make sense that the market profile is bullish on the daily time frame? Yes. Why? Because we took out this short-term low. So we're order pairing a low to a high. And then we have a key level in discount, which is important. If the key level was in premium, it didn't matter, but it is in discount of the range. So now we can know, okay, this market profile makes sense. So now we implemented our market profile with our key level and premium and discount. So going back to this piece of price action, this is the bullish market profile. And why is it bullish? First of all, you got to think about the PD array matrix. where are we disrespecting bearish fair value gaps, bearish arrays, where are we respecting the bullish arrays. So what does that look like? If you look at the order pairing, first of all, this is our draw on liquidity. We taught that in episode 3, right? Order pairing, very important. Lows get accumulated and we want to pair them up with the highs. Then we have a bearish fair value gap over here and it gets traded above. You can see over here, this is key. The closure of this candle closing above that bearish fair value gap is an indication we are having a change in the state of delivery. So the order flow is changing from bearish to bullish. As you can see over here, price was still respecting this bearish fair value gap and traded down lower down here. Price pushed up and then closed above. So this is an indication order flow is changing. Now, once order flow changes, we want to have a bullish array formed in the area, and we're going to touch that deeper on that later in the video as well, in the area where a bearish array was. So you want to have an area of old selling and confirm it with an area of new buying. So this bullish fair value gap over here makes a high probability fair value gap. Now, how are we going to actually focus on taking a buy setup? This is what we're going to discuss later in the video as well. You want to be in discount of the range, first of all, because when you order pair a low to a high, if price keeps expanding up higher and higher, yes, you can find entries in the premium level of that range. But if you're still in discount of the range, you should have the best opportunity to get into a trade. After we respect that bullish fair value gap, how every single previous daily high, except for this Monday candle over here, so a weird little candle, but every daily candle's high is closing above the previous daily high. And every time this is also the draw on liquidity. So let's talk bearish market profile. So over here we've got a Euro USD chart. Well, you can already spot where the bearish market profile is. Hopefully we can see an entire move down over here. And this is a recent price action, right? This is from October last year. So it's not too far away. You can clearly see price dropping down lower, creating bearish fair value gaps on the way. Very good indication that you're in a bearish market profile. Again, think about order pairing. Always implement the previous lessons in the model. So we see a range high getting purged over here, and then we want to pair it up with the range low down here. So that makes sense, right? For the draw on liquidity on the higher time frame. But does it make sense, just like the bullish market profile, does it make sense that we're going to go bearish from here? Is this logical that this is a smart money reversal and we're going to go into sell side of the curve? Again, we're going back to the weekly chart, see if that makes sense. Now, back on the weekly chart, we can see this range high got purged and we have a range low down here, right? So order pairing, once again, we have this bigger range and we're purging a high inside of the bigger range, right? And if you don't understand that this is high probability for a reversal, go back to episode 3 and I explained it crystal clear there why order pairing is so good to be utilized in higher time frame order flow as well. Over here, we purge the highs after we run this high as well. So this is a purge and revert. Not a classic fair value gap where that is a key level or an order block or anything. An old high is also part of the PD array matrix. So once you trade above an old high and it reverses, that is a key level. So now let's dive back into the daily time frame, right? Market cycles, previous episode, we can clearly see expansion into a retracement, into another expansion, and then we have a reversal. So market cycles are also in sync with our idea on the higher time frame. As always, you want to see a bullish array fail if you are wanting to see price go into sell side of the curve. We have a bullish breaker over here. So this is the last PD array that should be respected if we are bullish. So if we trade above this high and we fail to close above it and we start to trade through that bullish breaker, which was previously used for higher prices, then we have a change in order flow. Again, just like the bullish example, we violated that bearish fair value gap, and here we're violating a bullish array, which is that breaker. And from this point on, we are bearish order flow. So now our market profile switches to bearish. More indication that it's a bearish market profile, you can see continuously fair value gaps being printed in our favored direction. And also notice the daily lows keep getting closed below, and that's every time that's the target as well, right? This low gets traded below, and then the next low, and then the next low. This low gets closed in, price retraces back into the fair value gap, targets that low once again, until we reach that order pairing low from a range high to low. Now let's talk consolidation market profile. This is a market profile you definitely want to avoid. This is not something you want to trade. So once you can spot this, just don't start to analyze this asset and wait for it to break out on either side of the range. So over here we got a Euro Swiss franc chart, and most of my students know as well Swiss franc is one of my least favorite currencies because this happens a lot. So if you can look at this chart over here, we can see a clear-cut consolidation. Price is continuously closing and opening in the same range over here. So this is classified as a consolidation market profile. Nothing to see here. We don't want to trade this. We only want to go with the trend. The trend is your friend, as they always say. Now, if I divide it up in order pairing high to low, as you should always do, is that this high over here should be order paired with the low down here. But look at the point that it drops down into discount and then starts to consolidate. After a couple days, if it's still hanging around equilibrium of the range, you should just avoid it. This is not high probability price action. And look at the bodies of the candles, right? This body and this body high over here all stays inside the same range. So this is terrible price action to trade. Avoid consolidation market profile. Now this is going to be key, candle closures. A lot of people don't pay attention to candle closures, which is so important. I'm going to explain to you why that is. So first of all, let's talk about closure patterns. We have a bearish continuation pattern, we have a bullish continuation pattern, and we have a reversal pattern. Now what does that look like? First of all, this is a bearish continuation closure. Why? Because the body of the candle closes below the previous daily low. I want you to really remember that. And this is a bullish continuation closure. You can see the body closes above the previous candle's high. And this can be a previous 1 hour high. It can be a previous daily high. It could even be a previous 5-minute candle high. And this gives a lot of information of what the next candle wants to do. And then our key reversal pattern is going to be this one. So a bearish reversal looks like this. The first candle over here, and then the next candle takes out the high but closes back inside of this candle. So this is our reversal signature, and this is what we're going to be looking for if we want to sell in a key level. And the same for a bullish reversal. We want to see the low of the previous candle get taken out and then close back inside of this candle. These closures are very important so we can validate our key levels and where price action wants to go next. So candle closure will tell you a lot about where the next candle wants to go. So these signatures on its own, they mean nothing. And that's why you need to be aware of the entire context and narrative. So we're going to be talking about that right now. Let's look at this USD CAD chart again, right? We determined that this was buy side of the curve. We're market profiling this bullish and then the order pairing high and low. Now look at this candle closure pattern, right? We have a fair value gap here. So look at how this low of the candle gets taken out over here and the body closes back inside of this candle. Now we have this bullish reversal pattern, and this closure is very important to determine the next daily candle. So why is it so good that we have this closure? First of all, you always need to have a key level paired up with it. This is a pattern on itself. If there's no key level below it, it doesn't matter. You should not focus on anything. Just pattern wise, it always has to be context and narrative first. Key levels are very important. So after we close with that bullish candle closure pattern, we can focus on the next daily candle. This is going to be a high probability daily candle and a very easy daily bias for you the next day. So after this candle closes, the next day you should already be, okay, next day is going to be a bullish candle because we had that candle closure pattern and we have a key level and we're in discount and we have order pairing high to low. And look what happens afterwards, right? After we have that key level hit, closure confirms our direction. Every daily candle high gets purged until we are at the order pairing high. And I specifically took this example because I like to show examples where I took trades myself. And this is a specific trade I took myself. So if you look at the call outs over here, right? We'll be looking for USD CAD in discount tomorrow. This is after the daily candle close, right? What I just said with the candle closure. And then we're looking for the breaker intraday to form. And you can actually see once price closes above, and then you can enter the breaker and then you have a winning trade. That's the easiest way to determine your daily bias. Now let's talk about 4-hour market structure. If you want to have an easy directional bias, you will use the 4-hour as your lowest time frame to determine the higher time frame direction. So the reason is so that we can anticipate the market maker model being on the correct side of the curve as your higher time frame order flow. First of all, what is a market maker model? A crude depiction over here. It always goes from sell side of the curve to buy side of the curve. And you always want to use sell side of the curve to frame a setup on the buy side of the curve. There's going to be an entire different episode on its own as well. But for now, we're just going to keep it simple. It always starts off with an original consolidation, right? It starts off with this. This is also the draw on liquidity. when you are on buy side of the curve. And it has to have a smart money reversal. In between, there will be distribution and reaccumulation phases, but the most important part is that it has an original consolidation and a smart money reversal. Now, what does a smart money reversal need to have? It needs to have a key level. If there's not a key level, it doesn't matter where price reverses from, because this reversal might as well just be a retracement back to premium of the range and then keeps declining down. You will always want to have a smart money reversal in a key level. And after we have that smart money reversal hitting that key level, we want to focus on the next leg over here. This is going to be key in my model. We don't focus on the smart money reversal. We're not going to focus on the low risk buy or the low risk sell, which happens on the first leg. We're going to focus on the next leg. So over here, we've got a Euro USD 4-hour chart. Just look over here. Can you see buy side and sell side of the curve? And can you spot that market maker model? I will put some lipstick on the chart as always. We've got the original consolidation down here, which is required for a market maker model. And in this specific occasion, we have a market maker sell model because the original consolidation is on the sell side here. And then we have a smart money reversal up here. Now, a lot of traders want to get in once price displaces down lower. But I'm telling you, once you use my model, you want to let that low risk sell print first. So where is that happening? We can see the first bearish range over here forms the low risk sell. So this first bearish range, you want to see order pairing happen on the high to the low. And then we're going to focus on the leg that is coming out of that order pairing high to low. You can enter over here. And I do like to enter over here if the order flow is very clear. But you always want to use a stop loss on the dealing range high. If you're trading the leg down and you want to look for an entry in this area, you can put your stop loss on the high over here, and it doesn't have to be on the high of the dealing range. So zooming in a little bit. So let's look at this daily chart over here. Does it actually make sense that we're going into sell side of the curve and that smart money reversal? First of all, is it actually good? And what do we need to do to determine if we are in bearish order flow? First of all, we see a bullish for value gap. If we disrespect a bullish array, it's an indication that we can go into sell side of the curve. So look at the candle closure. Again, we're talking about candle closure. Look at this bearish reversal pattern over here. We take out the high on the 4-hour time frame, we print a low risk sell and we close back in this candle's range. So it's going to be a very easy daily bias the next 2 days afterwards. So why focus on these candles up here when you can have the easiest daily bias after you get those confirmations, right? And that's what we want to focus on. Now let's talk continuation purges. What is a continuation purge? It's the liquidation of an old low and then price action immediately reverses afterwards in bullish order flow. And in bearish order flow is the liquidation of an old high and then it immediately reverses afterwards. So over here we've got a couple examples. This is still the Euro USD 4-hour chart, and just to showcase how clean those continuation purges can be, right? Original consolidation, market maker model. Very important to know what side of the curve you're on to determine where you want to go and trade. So continuation purges are liquidations of old lows, as you can see over here, and then price immediately reverses away from it. That's a very key indication that price is in bullish order flow. You can also see the bodies are closing above the low here, which is also another good indication that price wants to trade higher. So candle closures, again, very important, even with continuation purges. Here again, taking out this low and then reversing immediately. So over here we've got very clear bullish order flow signatures, and then after the smart money reversal, again the low risk sell printed here. And notice how the bodies close above, and that it's not a hard rule that it needs to close below the high, but you can see it immediately reverses afterward as well. And same thing over here, price takes out this high and then immediately reverses down. So if you look at this USD CAD chart, 4-hour chart, same thing over here. Again, always look for order pairing lows to highs. You can see the low gets swiped over here. Key level is on the left of it. Then order pair it towards the high. And then you can see a break of structure. Can you spot continuation patterns? These are signatures of price action that is gonna stay in bullish order flow, and you can keep continuously looking for those bullish order flow trades. Right, and notice on the sell side of the curve, there is no continuation purge over here. Sometimes that doesn't happen. And if that doesn't happen, there's no trade setup, and that's okay, because we only want to put ourselves in the highest probability daily bias, and we want to look for those purges, right? We're essentially always selling an old high or buying an old low. If that doesn't occur, we don't get into a trade. Simple as that. And if you look at the buy side of the curve, we actually have a continuation purge over here. So if you use my model, we want to look for buys below old lows once price action is confirmed buy side of the curve, right? So if you look at the smart money reversal, then we have a lower sell printed. Next leg up prints out of it, but there's no short-term low to order pair. So we're not looking for a setup here. And then we have the second leg up, and then we can look for a old low to order pair. So what I typically do is buy literally the low of a range low in bullish order flow if the narrative and context is correct. And daily bias is going to be very easy if you use these continuation purges. So I'm glad you made it to the end of the video. Now I'm going to give you a practice routine so you can keep continuously practicing your daily bias. This is probably going to take you a while, and you have to do it every single day. Even if you don't know where the daily candle goes, you just write down, I don't know where the next daily candle goes because it's unclear, right? So what I want you to do is the following routine every single day, 30 minutes before the next daily candle opens up, until you are consistently predicting the next daily candle. So first of all, you pull out a higher time frame chart, a weekly, daily chart, write down the market profile. Where are we in the range? Premium or discount, like we discussed, did we hit a key level? Go back into the video if you missed that part, but really write down where are you in the range and is it premium or discount? Did we hit a key level? Then look at the 4-hour structure, right? Second thing, look at the 4-hour structure. Are we confirmed buy side or sell side of the curve? If yes, did we already print a low risk sell or a low risk buy to look for another leg up or down? You're going to be looking for any candle closure indicating that it's validating your direction. And think about the bullish reversal or the bullish continuation or the bearish reversal or the bearish continuation. And then look for those continuation purges to validate your strong highs and lows. So now if you can do all of this for the next couple of weeks, practice that daily bias, use all these steps I outlined for you, so you have a practice routine, you will see your daily bias accuracy increase tenfold. I'm pretty sure that will happen. And if you do enjoy these videos, guys, make sure to hit the like button, comment, get more exposure for this video. And I do appreciate everybody's support, and I will catch you guys in the next video.